There are at least 5 bank fees the average American is paying every single month, and not a single one of them is a fee you actually have to pay. Now, before we go any further, I need to clear something up because it is the reason most people click away from a video like this one and leave thousands of dollars sitting on the table. A lot of seniors assume a list like this is only meant for one kind of person, either someone who is struggling and pinching every penny, or someone comfortable enough to be playing fancy money games, and both of those assumptions are wrong, because this list is genuinely for both of you. It does not matter whether your whole income is a Social Security check, or whether you have got a pension, some savings, and a paid-off house. There is real money on this list with your name on it, and on every fee we cover, I will tell you which group walks away with the bigger win. The reason nobody ever tells you about these fees is simple. Every single person collecting that money from you has a financial reason to stay quiet about it. Your bank is not going to call and tell you the monthly maintenance fee on your account can be waived with one phone call. The branch manager is not going to mention that the savings account you have been loyal to for 20 years is paying you almost nothing, while a federally insured account down the street is paying 10 times more. And the biggest one of all is the interest your own savings should be earning you right now, which is going straight into the bank's pocket instead. And for a lot of retirees, that one alone quietly adds up to over $1,000 every single year. In the next few minutes, I'm going to walk you through all 5 of these, one at a time, because being allowed to skip a fee and actually not paying it are 2 completely different things in the real world. The bank is not going to refund you, and nobody is going to mail you a check in the post, which means you have to know the rule exists in the first place, and then you have to go and claim it yourself. That is the entire reason this video exists. My name is John, and the single most painful pattern I have seen over and over again is not people being careless with their money, and it is not people being foolish either. It is honest, careful retirees who have been paying fees they never actually owed, month after month, year after year, simply because nobody ever sat them down and told them they were allowed to stop. That is the most expensive kind of mistake there is, because it is completely invisible to you, with no warning and no penalty attached to it, just money quietly walking out of your account every single month that never had to leave in the first place. So let us put a stop to it right now. Stay with me to the end, because the last fee on this list is the one most seniors do not even realize they are paying, and it also happens to be one of the easiest of all to shut off. But we are starting today with the biggest one of them all. Fee number 1 is not a charge on your statement at all. It is worse. It is money you should be earning and are not, and the bank is pocketing the difference. I call it the lazy cash fee, and it is the single most expensive thing on this entire list. Here is what is happening. As of May of this year, the national average interest rate on a savings account in this country is 0.38%. That is the FDIC number, the average across thousands of banks. And a lot of the big brand name banks pay far less than even that. Some of them pay as little as 0.01%. Meanwhile, a high yield savings account, or a good credit union, will pay you somewhere around 4% right now. Same dollars, same safety, a completely different result. Let me show you what that actually means in money, because the percentages do not land until you see the dollars. Say you have $20,000 sitting in a regular savings account at that national average. Over a year, that money earns you about $76. Now take that exact same $20,000 and put it in a high yield account at 4%. That earns you about $800 in the same year. That is a difference of around $720 every year that the bank is simply keeping by paying you almost nothing. Over 10 years, with the money compounding, you are talking about thousands of dollars that should have been yours. Now, I know exactly what some of you are thinking, and I want to kill this fear right now, because it is the thing that stops people. This is not the stock market. This is not risk. This is not gambling with your nest egg. A high-yield savings account is FDIC insured up to $250,000 per bank, which is the exact same protection your current account has. Your money is just as safe. It is just as easy to get to. It simply pays you a fair rate instead of an insulting one. Who does this one help the most? This is the win for the comfortable retiree, the one with a real balance sitting in the bank. And I am saying that directly because you are the very person who assumed the rest of this video was not for you. If you have got money parked, this is for you more than anyone. So here is your move this week. Open an FDIC insured high yield savings account or one at a credit union and move your parked cash into it. Not your daily checking money, the cash that just sits there. And do not drag your feet, because here is the honest part. Rates have been drifting down since the Fed started cutting late last year. So the longer you wait, the smaller the gap gets. The time to move it is now, while it is still around 4%. That is fee number one, and it is the big one. Now let us talk about the fee that shows up on your statement every single month for absolutely nothing. Fee number two is the monthly maintenance fee, sometimes called a service fee. It is a charge you pay just for the privilege of letting the bank hold your money. And in January of this year, the average monthly maintenance fee in this country hit a record high, $13.95 a month. That is about $167 a year, paid out for nothing in return. Now here is the trap that catches millions of seniors. The four biggest banks in the country, Bank of America, Chase, Citibank, and Wells Fargo, do not offer any senior-specific accounts at all. So a senior walks into one of those banks, asks if there is anything for older customers, hears no, and walks out thinking, well, there is nothing for me. And at that bank, they are right. That is the trap. People assume that because the giant bank has nothing, nobody does. But the regional banks and the credit unions are a completely different story. TD Bank has an account called 60 Plus, where the fee can disappear once you are 60. Regions has one called 62 Plus Life Green for customers 62 and older that even waives the paper statement fee. US Bank, PNC, First Citizens, they all have senior-friendly options. Now, I am naming those as examples, not as recommendations, and the terms change all the time, so you call your own bank and you ask about your own situation. But the point stands. The options are out there, they are just at the banks nobody told you to look at. And here is the angle that helps everyone, no matter your income. A lot of banks will waive that monthly fee for any qualifying direct deposit. And your Social Security check counts as a direct deposit. So just by having your Social Security routed through the account, you may be able to kill that fee entirely. Who does this one help? Honestly, everyone. It stings the most for the senior on a fixed income, where $167 a year is real money. But the comfortable retiree is usually paying it too, on autopilot, never even noticing. So here is your one phone call this week. You call your bank and you ask two things. What do you waive for customers over 60? And does my Social Security deposit qualify me for free checking? That is the whole call. That is fee number two. Fee number three is the one that makes people genuinely angry once they understand it, because it is a fee that punishes you for being short on money. It is the overdraft fee, and the one that goes with it, the insufficient funds fee. The average overdraft fee in this country right now is about $30 every single time it happens. This time, 2 payments in a month, which is the easiest thing in the world to do when you are living on a fixed schedule, and that is $60 that month. Do that regularly, and you are looking at $700 or more a year. Think about that. You are being charged $30 because you were a few dollars short. That is the fee that hits hardest exactly when you can least afford it. Here is what almost nobody realizes. The bank signs you up for this on purpose. Most banks enroll you in overdraft coverage by default, which sounds helpful, but all it really does is let them approve a transaction you cannot cover so they can charge you the $30. So here is your first move. Call your bank and opt out of overdraft coverage. When you do that, if you do not have the money, the transaction is simply declined. No purchase and no $30 fee. Nothing happens at all. Your second move is to set up overdraft protection, which is a completely different thing, and do not let the similar name confuse you. Overdraft protection links your checking account to your savings account, so if you come up short, the bank just moves your own money over to cover it. At a lot of banks, including some of those senior accounts I mentioned, that transfer is free. It is your money moving from one of your accounts to another, not a fee. Who does this one help the most? It is sharpest for the senior on a fixed income where one mistimed payment can cascade. But truly, anyone can mistime a bill, so this is one everyone should set up. That is fee number 3. Fee number 4 is 2 small fees that hide in plain sight, and the reason they survive is that they are small enough that you never bother to question them. These are paper statement fees and dormancy fees. The paper statement fee is the bank charging you, usually $2 to $5 a month, to mail you a paper copy of your statement. It does not sound like much. But $5 a month is $60 a year, paid out so the bank can mail you a piece of paper you probably glance at and throw away. This one hits everyone, and the fix takes about 2 minutes. You switch to electronic statements, or you confirm that your senior account waives the paper fee, because some of them do. The dormancy fee is sneakier, and it tends to catch the comfortable retiree specifically. Here is how. If you have a second account, an old savings account, maybe one you opened years ago and forgot about, some banks will start charging you a fee for not using it. They call it inactive or dormant, and then they quietly start eating away at the balance, a few dollars a month, on money you are not even watching. The fix is simple once you know about it. Make one small transaction in that account each period, even moving a single dollar, and it stays active. But first you have to know which of your accounts is at risk, so go look. And there is one more small fee that belongs in this same group because it lives by the same trick, charging you a little so often that you stop noticing. That is the out-of-network ATM fee. Use the wrong machine and you actually get hit twice. Your own bank charges you somewhere around $2 to $3 for using a machine outside its network, and the owner of that machine charges you another $3 to $5 on top, all for one withdrawal. Pull cash twice a month at the wrong machine, and you have quietly paid over $100 in a year, just to touch your own money. There are 2 easy fixes for this one. The first one is to find out which ATM network your bank or credit union actually belongs to. A lot of credit unions are part of a shared network called Co-op, and many banks belong to one called Allpoint, and between them they give you tens of thousands of fee-free machines across the country. Your bank's app or website will have a finder, and it takes about 30 seconds to use. The second fix is even simpler. When you are already at the grocery store paying for your shopping, ask the cashier for cash back at the register. There is no fee, there is no machine to hunt for, and the cash comes straight out of your checking account just like an ATM would have given it to you. That is fee number 4. Fee number 5 is the one aimed squarely at the retiree who has saved up some money, and it is a trap that gets set quietly and springs later. It is the certificate of deposit early withdrawal penalty, along with the safe deposit box fees that creep up over time. Now I want to be straight with you about this one. Here is what happens. A senior walks into the bank and somebody steers them into a CD, a certificate of deposit, because it pays a little more interest. Sounds good. But a CD locks your money up for a set period. And if you need that money before the term is up, the bank hits you with an early withdrawal penalty, often 3 to 6 months of interest. That penalty can wipe out most or all of the interest you earned, and in some cases, it can even take a bite out of the money you put in. The real danger is locking up cash you might actually need. I am not going to tell you to go break a CD you already have this week, because depending on your terms, that could cost you the very penalty we are trying to avoid. So let me be honest about what this week's move actually is. This week's move is a decision, not undoing something you have already got. Before you ever open a CD, get the penalty terms in writing. Build what is called a ladder, where you stagger several smaller CDs so that some of your money frees up regularly without any penalty. Let me show you what a ladder actually looks like, because the word gets thrown around without anybody bothering to explain it. Say you have $20,000 you want to put into CDs. Instead of locking the whole $20,000 into one 5-year CD and praying you do not need it, you split it into 4 pieces of $5,000 each. You open one for 1 year, one for 2 years, one for 3 years, and one for 4 years. So every single year, one of those CDs matures, and that money is yours again, free and clear, with no penalty of any kind. If you need it, you take it. If you do not, you roll it into a new 4-year CD and you keep the ladder running. What you get out of all of that is the higher rate the longer CDs pay, without ever having every dollar locked up at the same time. That is the whole idea. Know that no penalty CDs exist and ask about them. And remember, for any money you might need to reach, that high yield savings account from the very beginning of this video often pays you about the same with no lockup at all. The safe deposit box is the smaller piece of this. Those annual fees tend to creep up year after year, and a lot of senior accounts will discount or waive them, so it is worth asking. And while you are at it, it is worth asking yourself whether that box is still holding anything that earns its keep. Who does this one help? This is the comfortable retiree, the one with savings to lock up or valuables to store. That is fee number 5. So let me run all 5 back fast, and I am going to use that word cancel out loud because that is the whole point. Cancel the lazy cash drain by moving your parked money into a high yield account. Cancel the monthly maintenance fee with one phone call. Cancel your overdraft exposure by opting out and linking your savings. Cancel the paper and dormancy fees by going electronic and keeping your accounts active. And cancel the CD trap before it ever catches you by making the smart decision before you sign. Every single one of these is real. Not one of them is automatic. And every one of them can be started this week with one call or one switch. Because here is the idea I want you to walk away with more than any single fee. The law lets you, the bank allows it, the better account is sitting right there waiting. But being eligible to stop paying is not the same as actually stopping. The bank does not refund you. Nobody mails you a check. The money keeps leaving until you stand up and stop it. And it does not matter whether your income is small or comfortable. And let me leave you with this. The people who collect these fees are counting on one thing. It is not that you are dishonest, and it is not that you are careless. They are counting on the fact that you assume the good stuff is for someone else. The senior getting by assumes the breaks are for people with money. The comfortable senior assumes the relief is only for people who are struggling, and so both of them keep paying. That is the entire game. So do one more thing for me. Send this video to one person in your life who needs to hear this. A parent, a neighbor, a friend from church. It does not matter if they are getting by on a single check or sitting on a paid-off house. The odds are very good they are paying at least one of these fees right now for no reason at all. And one share from you could be worth more to them than any gift you will ever give. That is what this channel is here to do. I will see you in the next one.